Most people think they're investing when in reality, they're just simply gambling with better clothes. Today on Stoncast, we continue our value investing series with part 2, and stick around till the end for a sneak peek of part 3 next week, where we take all Benjamin Graham's investing philosophy, break it down practically for 2025. Now, let's get into it. Welcome back to Stoncast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host as always, Brandon Shar. Welcome back, and we are continuing our value investing series, part 2, going off of The Intelligent Investor, the book written by Benjamin Graham, the father of value investing, the man who mentored Warren Buffett, arguably one of the greatest investors of all time. Let's jump right into it. So, and as a quick note, for those on YouTube, my apologies ahead of time for my very amateur Canva presentation. For those on Spotify or iTunes, you have been spared. All self-deprecating talk aside, let's get into it. Investing versus speculating, or maybe you'll call it gambling. Some people might call it that. Basically, this is what separates Benjamin Graham's philosophy on investing from some other people, right? This was his simple test. Are you investing or are you speculating? So let's get into it. Basically, when you take a look at Benjamin Graham, the way he approached the market, right, he would classify it as investing. This is how he would consider investing. Analyzing the business. What does that actually mean, right? So when we're talking about analyzing a business, there are a couple different ways that you can do that. One would be from a quantitative approach. One would be from a qualitative approach. Just to break those down quickly, a quantitative approach is going to be based off the numbers strictly. So that could look like a few different things. It could look like the price to earnings ratio. It can look like, how many assets does a company have, right? Versus how many liabilities, price to book value. There's a lot of different metrics out there, a lot of different ratios. But these are things that are very black and white that you can find. The other angle would be a qualitative approach. Qualitative approach is going to be more so, where do you think the company is headed, right? What are the prospects for the future? Does it have good management? Benjamin Graham tended to lean more towards the quantitative side of things, right? He stuck to the numbers. If we look at Warren Buffett started out more on the quantitative side and then grew more into a qualitative approach, right? Where he's valuing companies based off of their management, how well that management is holding up, are the investors happy, are customers happy, right? So those are really the two different ways, very simply put, that you can analyze a business. Another aspect to investing for Benjamin Graham would be, are you expecting a safe return, right? This could also be considered a margin of safety, right? So are you able to analyze a company and understand that, based off of where it's trading at right now in the stock market, you actually have, you have a cushion, you have a margin. So can you expect a conservative or a safe return on the company itself? Another component, just a real world example of this, right, would be buying dividend stocks, which are undervalued. So dividend stocks, right, companies that are actually paying out, whether that be quarterly or annually, paying a dividend. And there are a host of stocks in the stock market that do this. And for Benjamin Graham, he had 2 classifications of investors. One would be a defensive investor. Another one would be an enterprising investor. A defensive investor is going to be someone who's a bit more conservative Enterprising would be somebody who wants more hands-on, action with their investments. And so as it relates to dividends, a defensive investor, according to Benjamin Graham, would be somebody who is looking at stocks that paid consistent dividends for at least 20 years. And you might say 20 years, that's a long time, but there are a ton of stocks that do that. I believe Coca-Cola is a great example of that. They've been paying out consistent dividends for a long time, and you even have some companies that have been paying dividends for over 25 years, over 50 years. That would be an example for Benjamin Graham, right? When it comes to investing, what he's looking at. As far as the enterprising investor goes, the one who's a bit more hands-on, you have a bit more leeway. Maybe you're looking at companies that pay dividends for at least 5 years. So not 20, but, still showing some consistency. Now, investing, according to Benjamin Graham, is set against what he would call speculating, right? And he really lays this out from the onset in his book, The Intelligent Investor, that the book is written for investors, not speculators. So what am I talking about when it comes to speculating? So speculating would be somebody who is hoping to sell for more than what they bought it, right? Very simply, you're looking at capital gains. You're looking to, buy a stock for $10, and you're hoping that it goes up to 15 or it goes to 20, right? That's how you would classify a speculator. The problem with speculating is there is no margin for safety in most cases. And this is apparent when you just look at, some of the high-flying names in tech, for example, that wouldn't even come close to getting on Benjamin Graham's radar when it comes to that quantitative side, right? They could have price to earnings ratios that far exceed what he would consider for an investment. So a lot of high-flying tech names are going to have PE ratios well above, 20, which is generally what Benjamin Graham looked at. It could be as high as 100, 150. I think Tesla is a great example of this. I believe the PE ratio on Tesla last I checked was something like 140, right? Very, very high. So not a lot of margin for safety as it relates to what the company is actually bringing in. And so, this would be classified again as speculating. A real world example would be YOLO meme options. Look, okay, the show is called Stockcast, right? I took that from, the Wall Street bets community. I love that community. I love speculating. I'm a trader. We all love a good 0 day to expiration option that goes up 600%. I enjoyed some of those high flyers just yesterday with Tesla breaking out above 300. But at the end of the day, this is considered speculating. This is not what Benjamin Graham would classify as investing. So according to Benjamin Graham, in his view, speculation isn't evil. I want to be clear about that. It's just dangerous if you don't realize you are doing it. So true. If you think you're investing, but in reality you're speculating, that's when you can get into a lot of trouble, right? That's when you can be facing some massive drawdowns and wondering, what the hell's going on? What did I do wrong? You have to be clear when it comes to his style of investing. You have to be clear about what you're actually doing, right? You have to have caution. Risk management, of course, is a huge piece of this. So another key point here, margin of safety, right? So this is a very, very important component to Benjamin Graham's philosophy when it comes to investing. This is how smart investors protect themselves. So what is a margin of safety according to Benjamin Graham? It means buying with a cushion, right? So let's take an example of real estate, buying a house. So the house may be worth, let's say, $300,000 hypothetically, but you bought the house for $200,000. That would equal a margin of safety of $100,000. And so this puts you in a position where even if the value of the home doesn't continue to appreciate, which historically real estate just goes up, right? But let's just say hypothetically you went through a time frame of a decade where nothing really happened, or maybe the housing market comes down a little bit. You still have that margin of safety of $100,000. And so that's really important to the philosophy of investing that Benjamin Graham talks about as it's applied to the stock market. Of course, he's looking for companies where he can buy it with a margin of safety. And so an example of this when it applies to stocks, something that Benjamin Graham talks about in The Intelligent Investor, would be a company that is trading for less than its net asset value, right? Now, these are kind of rare to find, or if you do find them, there are some that you just don't want to buy anyways because of various fundamental reasons, or they could be going out of business. But on the rare occasion that you can find one of these companies, you're essentially buying with a margin of safety because the company is currently trading for less than it's legitimately worth based off its assets minus its liabilities, right? So this is a very, very important principle to value investing for Benjamin Graham. Again, margin of safety. According to Benjamin Graham here, the essence of investment management is the management of risks, not the management of returns. So that's, an important concept here. As I mentioned in part 1 of this series, Benjamin Graham came over to the U.S. in the early 1900s. His family lost everything. And so from a very early age, he was influenced to be very conservative, which goes well in investing, right? So for him, he wasn't really focused on the returns. He was focused on managing risks. That is the essence of investment for him. So it's not about, hey, can I make 100% on this in a year? It's about, hey, do I have that margin of safety? All right. So how Graham approached risk, right? So avoid overpaying no matter how hot the market feels. So I'll speak for myself. I have definitely fallen victim to FOMO, fear of missing out, with certain companies. As they go up, and you wonder, am I going to miss out on this? I got to get in, right? An example right now, Palantir. Palantir has been flying, right? But according to Benjamin Graham, you don't want to pay attention to that if you're value investing. You want to avoid overpaying. Actually, that would be the time that it would be ideal to sell it, or completely avoid it if you're not already in it, right? When a company is flying high, no matter how hot the market feels, right? So it's his approach is in the same for Warren Buffett, who of course was mentored by him. It's very counter to majority of what the market thinks. Majority of investors, majority of speculators, traders, when things are going up, they hop in. When things are going down, they sell. When in reality, it needs to be flipped from this perspective of investing for Benjamin Graham, for Warren Buffett. Warren Buffett has famously said, be greedy when others are fearful, and be fearful when others are greedy. When things are low, when the market's tanking, that's when you can find value, right? That's when you want to be looking for, those opportunities to get into solid companies with solid fundamentals. When the market is flying high, when everyone's greedy and prices are insane, that's when you want to be fearful. Consider trimming positions. Consider selling positions. It's not an ideal time to be a buyer, although everyone else seemingly is doing it. Focus on companies, not stock prices, right? So instead of, focusing on the ticker symbol and what, Wall Street has a certain company trading for on any given day, Benjamin Graham is focused on companies. You have to view yourself as a part owner, which when you're buying stock, you are that, right? You want to focus on the company itself. And this helps you get into a mindset where you can focus on the quantitative side of things, right? You can focus on qualitative features of a company, good management, good assets to liabilities, good balance sheets, right? Things like that. Focus on the companies. And also don't predict the future. Build in protection for the future. Again, that margin of safety that I mentioned earlier is a very, very key component for Benjamin Graham. So one of my favorite quotes from the book, The Intelligent Investor, as it relates to this whole idea of not predicting the future here at the bottom. One of the central points of the book: all investors labor under a cruel irony. We invest in the present, but we invest for the future. And unfortunately, the future is almost entirely uncertain. Therefore, investing based off projection is a fool's errand. For most people, investing based off protection from overpaying for a stock and from overconfidence in the quality of their own judgment is the best solution. So very simply, he's saying, that the cruel irony of the markets is we're investing in the present, but we're doing it for the future. And so it's more important to focus on what you actually can know versus what you can't know. Forward PE ratios, right? Projections, guidance for the future from companies. Those are nice to have and can kind of give you an idea, especially if you're more of a qualitative investor. But at the end of the day, because the future is almost entirely uncertain, it's more important to focus on what you can know, which would be earnings reports that have come out in the past tense, what the asset to liabilities are for a company. These are more important, according to Benjamin Graham, because it's going to give you an idea of whether or not you can actually have that margin of safety. And the future is almost entirely uncertain, as Benjamin Graham says. We all know that. Nobody could have predicted, the tech bubble in the 90s, or 9/11 happening, or Russia invading Ukraine in 2022. These are all things that are uncertain. Things are constantly changing. The only thing for certain is uncertainty, right? And so, that's how Benjamin Graham would approach, investing from a more conservative approach. So that is my brief rundown of part 2 of the value investing series. Next week, we will tackle part 3, folks. We're going to actually take all of this high in the cloud philosophy of Benjamin Graham. We're going to bring it down to the ground, practically speaking. And we're going to talk about Benjamin Graham's stock criteria updated for 2025. I've taken his very, practical requirements for stocks as he would, value companies, right, in the early 1900s. And with a little bit of help from ChatGPT, was able to crunch the numbers and apply it to basically today's age with current inflation and where bond rates are currently. So that'll be next week. We'll break down Graham's stock criteria. Make sure to like and subscribe, and leave a comment. Let me know what you think about the series, anything else you want covered. But definitely like and subscribe so that you can get notified when we drop part 3 next week. As always, I will be back tomorrow, Sunday, for a market recap from the week before. And we will also be looking ahead to see what can we potentially expect out of the market, more so from a speculating standpoint, as currently right now the US and China are in Geneva for their initial trade talks. So stay tuned. Thanks as always. And remember, folks, plan the trade and trade the plan. Have a good night.